Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. Hello, sir. How are you?
Jared, I am well.
How's your day going?
It's going great, Jared. How are you today? You're not here. Where are you?
I have been pretty lucky to be traveling all over the place. Some has been for medical stuff. This one's actually for leisure, to be able to get out into Big Sky, Montana area, meet up with a couple of old buddies. It's been great. We're having a great time.
Oh, that's awesome. I'm so jealous. I would love to be out there skiing with you.
Yeah,
What?
that's the, I got Mr. Casual here today with the hoodie going on. Just happy to be here.
I love it. You're probably overdressed for Bozeman, or not Bozeman, but Big Sky.
Yeah, that's fair. That's fair. That's fair. What's new in your world? What have you been working on?
Well, gosh, I've been doing a little bit of trading, changing airplanes, as you know about, and
Yep.
I've been working on some real estate deals, and I've been working on a conversation for you and I to have
Yep.
on infinite banking.
Yep.
And one of the things that I thought it might be illustrative for us to talk about is why infinite banking is such a bad idea.
It is. It's an absolutely horrible
Awful
idea. I can't believe anybody would ever consider it.
Awful idea. And so I thought we might plumb the depths of the major objections out there, just
I love
to
it.
set the record straight. So one of the big things, Jared, that I hear a lot is, life insurance. The whole life insurance is too expensive.
Too expensive. Nope.
I
Can't
go
work.
by term and invest the difference, right?
That's right.
It's so
I'd say it makes it
expensive.
easy. That's right.
But when people understand the construction of a whole life insurance contract, there's way more than meets the eye, isn't there?
There is. Totally
Term
agree.
insurance buys you death benefit only for a set period of time. It's exactly what it's structured to do. There's no cash value. There are no riders with it to speak of. It's purely to cover a liability, and it makes sense under certain circumstances for sure.
Sure.
But
No,
it's
that's right.
not whole life insurance.
That's right.
There's the other end of the spectrum are dividend-paying whole life insurance policies. Now
Sure.
this is something with some meat on the bones.
That's
And
right.
then in the middle, you've got these derivative products, where they try to make a synthetic blend and call them a permanent product when they're
Yep.
really not. It's still
Agreed.
an annualized renewable term,
Yep.
which gets more and more expensive every single year because mortality costs go up. The older we get, the more expensive we are to insure.
That's
And then
right.
there's a side account with a IUL or UL accounts or VUL accounts, a bunch of
Yeah.
different derivative products.
That's right. Yep.
And there are the costs that are involved. You get what you pay for. It's not, let's see what works. You and I have seen enough of those policies that were put in front of us and said, we were going to see what works, and they didn't work out so well. And we wind up doing a 1035 exchange on them, rather.
Yep.
So
Yep.
high cost is one.
High cost
How about
is one.
another?
And hey, I'll give you, I'll build on that a little bit on the high cost. That was one
Sure.
of my big qualms with infinite banking concepts when I first learned about it. I thought the same thing. I thought it was too expensive. I only was viewing it through the lens of the death benefit that was purchased for the dollar that was paid in premium. And I had no idea what was behind the scenes, what other things you were gaining, what other things you were gaining access to,
Yeah.
and how you're able to build this year over year over year. So I'm guilty of being in this myself. One of the reasons I didn't dive headfirst into infinite banking concepts when I first heard about it was because I thought it was too expensive. Now,
Yeah.
obviously, we can all understand that's not me anymore. It took me a little bit of time to rethink my thinking and to, recage the gyros, so to speak, to understand what you're truly gaining and how you can gain access to, your funds, your capital, and have a living benefit. Nelson would have told us that it's the need for finance is more important while you're alive than when you're dead.
For
So
sure.
100% agree with you, and am guilty myself. I would have said this back in the day. It's too expensive. But, if you look at this in what you are actually getting and the benefits that are achieved, it's not more expensive. It's actually cheaper for what you get in the long run. Would you agree with that?
Absolutely. There's like one benefit with a term policy. There's like 17 plus benefits with a dividend paying whole life insurance contract. Not the
That's
least
fair.
of which is the banking function. Your cash value grows year over year, guaranteed, and typically we see anywhere from 8 to 12 years. All the money that you put into this thing is sitting there in cash value. And oh, by the way, you've got all that backstop life insurance and all the riders that we've covered in other places, so I won't go into those. But
Agreed.
there's
Yep.
so it's so worthwhile having the conversation with Jared. Call Jared or call me, and we'll be happy to go over this stuff with you.
Agreed.
So
Yep.
the high cost thing is just it's a fallacy. It truly
Sure.
is.
Yep.
Complexity. How about complexity, Jared? I mean,
Complexity. Yep.
this is not hard. People. One of the things that was told to me a long time ago is if you can't teach it, you don't know it. And what's the core of teaching? It's communicating what you know to somebody else. On complexity, call Jared. Call me. If the guy can't explain this to you, then in words that you understand, talk to somebody else, because this is not hard. This is core to understanding infinite banking, are the concepts behind it, and they are as simple as the day is long.
Yeah, and there's a really fine line to walk here, right? Because generally speaking, when we're talking vanilla whole life policies, right, these don't get any simpler. When we're talking about the structure that the various insurance companies are using to set these up, they are beyond simple. If someone like me can understand it, believe me, anybody can, right? So those products themselves are simple. Now, the process itself can get a little bit complicated, but if you are willing to step outside the box and learn a couple of things maybe that are outside of the mainstream, or just learn something new, I think you'd be blown away by what information is available and what you'd learn by just trying to dig into this a little bit.
Yeah.
So even maybe building on the complexity piece a little bit, you've got to work with an authorized practitioner. They've gone through the Nelson Nash Institute. They've learned what it looks like to build a properly structured dividend-paying whole life product that will serve you well in your lifetime of infinite banking concepts. So it's not just the thing everybody can do, right? You don't just call up your brother-in-law who happens to be an insurance broker and go, "Hey, build me an infinite banking concepts, style whole life policy." I bet he'd try real hard with all the best intentions. But so there is a little complexity there, right? That's why we would recommend that if you ever go down this path, make sure you're working with a practitioner. After that, the day-to-day is pretty simple. Like, these are plain vanilla dividend-paying whole life insurance contracts or policies, of which you get to take over the banking function for your household. We're not talking complex math. We're not talking complex algorithms. We're talking pretty basic, straightforward there. So, like I said, it could be kind of a tough line to walk with the complexity, right? But when you're talking day-to-day operations, when you've got it in place and you're hit the road running, seems pretty straightforward to me.
So when we're talking about complexity, Jared, you can build this thing out. It's fully scalable. What's so important is that you learn from the beginning the simplicity of the model. It's so simple, and you can build it out.
Well,
if you're going to teach somebody to fly a jet, you don't start in a jet. You start in a 152 or a 172. You learn the four forces of flight and all of the stuff that you learned going way back when. And you apply it. When you're flying a 330, that ADI, that attitude indicator in front of you, works exactly the same with the airplane as it did when you were flying a 152. The concept is the same. It's scale. Now, if you want to learn to fly an airplane, don't go to a racetrack and say, "Hey, I want to learn to drive a Porsche fast." They're different things. And that's the importance of the complexity. Keep the complexity focused on what you're doing and pick the right team to teach you the basics. And that is what we do so well, I believe.
I agree with that. Yep. So
tooting my own horn.
That's well said. No, perfectly said. So there is some complexity, but you can eliminate that complexity by choosing the right team and having the right folks behind you that can help make sure your education is sound, so that when you're off and running, you've got what you need and you're well informed on what you've built.
100%.
Yep.
All right. How about surrender rates? People complain, "Oh, you got to pay surrender rates." Do you? Talk about surrender rates. Only if you give up the policy.
That's right.
You don't want to give up a policy. These things become more and more powerful as they snowball into bigger and bigger things down the road. So why in the world would they surrender them? Unless they didn't understand what they were doing in the beginning. The old Stephen Covey thing, begin with the end in mind. If you have an objective, stay focused on where you're going. Don't get off
That's right.
track, because if you get off track and you steal the peas, you don't put money into the contract, you
That's right.
max loan out the thing, you don't pay your premiums, yeah, it's eventually going to lapse. Or somebody could just say, hey, I owe too much money on this thing, meaning I've stolen the peas and I don't want to put them back, and they're going to surrender it. That's a bad idea. Don't do infinite banking if this is your objective.
Sure.
You have to have clarity of what you want to do.
There's the human element, right? If you're
Exactly.
stealing the peas, if you're not following, sound budgeting practices or concepts, you can't steal the peas. You can't take a loan with zero intent of ever paying it back, I mean, unless you're later in life and you just know you're recapturing some of what you've built, right? But that totally different story on that, right? But when
Right.
you're day to day, when you first set this up, you're wanting to use the capital you've put into it. That's exactly why you've set it up this way.
Yeah.
Yet, if you steal the peas and the human factor takes you by chance, then that's when the surrender can come in, right? But the surrender rates apply to anything, right? The surrender rates is not going to apply to a term policy. Again, assuming that you continue to pay your premiums. That a surrender rate applies to a IUL, a VUL. They're all under the same category. If you stop paying your premiums, or if you don't pay back your loan over a long period of time, they're going to come at you and say, hey, what's your plan? So we're talking outsider cases though here, right? We're not talking about the normal, we set up a plan, I worked with a practitioner and I held to that plan. So I guess when we talk about when infinite banking is such a bad idea, if you set up your plan and you don't follow your plan, I mean, whose fault was that? Who
Yeah.
made it such a bad idea? So, the human element part of that is really important.
Surrender rates are purely for apply to people who don't follow the plan and lack the discipline to implement their plan. Otherwise, if you just do the basics, the minimums, and there's a range of what's possible. You can do a minimum, you can do more than that. You can
Yeah.
scale this thing way up. Do the minimum if you need to. You're fine. You're absolutely fine.
Also had some scenarios where, and these are friends of friends, right? I've been fortunate to not have to see this personally, but you've got a very disciplined, very structured family, husband and wife set up an amazing plan, and it includes their kiddos. And then kiddos turn, mid-20s, they turn the policy over to them. They're out on their own. Kiddo goes, holy cow, $100,000 cash value? Yes, please. And now they cash it in, they surrender it, not having
Bad idea.
any clue what has been built for them and what lies ahead. So there, but again, that's an education piece, right? That's someone that wasn't aware of what truly was built for them, or the education was not passed on, from mom and dad to that person. That's sad when that happens too, but it happens. I think you had told me, approximately 80% of all policies sold get abandoned. That's a lot of policies.
And the reason that's bad communication between the agent and the client. That should never happen. It shouldn't. Because if that's even on the horizon, don't do this.
Yep.
It's not worth doing this. But that's surrender rates are significant if you're careless. But you can be careless with a lot of different things. You go buy a car and you get a loan on the car and you're driving the car. You owe the bank the money. Well, you're the bank. You don't pay the bank. What happens? They're going to take the car back. Same darn thing. Same concept applies. All right.
Totally
I think we hit that one. How about limited accessibility? This is one of the objections. It's too restrictive. Are they conflating whole life dividend policies with perhaps IULs that aren't really performing well? Talk about that a little, if you would, Jared.
Yeah, that one, I guess I'd need a little more frame set on that one as to why someone would say you have limited accessibility. I know for me personally, every single time that I go to a portal and say, hey, I'd like to access some of that cash value that I've built up, it goes, how much do you want? And then in 3 days, it shows up in my bank account. No questions, no loan application.
Easy.
No, what are you doing with this? If I haven't gone over the threshold that they use. Some of them use a $50,000 threshold. If you go over that, you just need to call them up and tell them a little more heads up as to that you need that much. There's still no discussion, no application, no further questioning. So for someone to say that there's limited accessibility, I don't know. I don't want to claim ignorance, but that seems like someone's not very well informed on the availability.
Yeah, but if you borrow against the policy, you can reduce the death benefit. Really? No, the death benefit doesn't change. What
The death
happens is
benefit doesn't change.
unless it's an IUL. If
That's
it's an
fair.
IUL and you take the money out, that death benefit may very well go down. But on a
That's fair.
permanent policy, the kind that you and I deal in, the death benefit never goes down. Here's
As
what
you say
happens.
that, I'm sorry, go ahead.
Well, here's what happens is
Yep.
when a death benefit, there's a follow-on to this too, on a taxability question I had the other day that I was going to answer. What happens is if somebody passes and they have one of these policies and they've got a loan against it, well, guess what? The insurance company, they pay the whole death benefit minus the existing loan and interest if there's
Right.
any interest due on the thing, and that's it.
Correct.
So all
Yep.
that money passes tax-free. There was a guy out there, and I won't identify him publicly because he was wrong, but I wanted to hit this. He said, if you've got a loan out against one of these policies and you die, you could create a tax consequence for your heirs. Absolutely incorrect, because
Correct.
that money
Incorrect.
passes to them after it's been paid off internally, and the money that's been distributed is all after-tax money, or
Yep.
is all tax-free money, I should say. So,
You know, as you're saying this, it's kind of reminding me of when you read the book, Becoming Your Own Banker by R.
Right.
Nelson Nash. He does use some scenarios in there where he'll do a partial surrender. So you do reduce the death benefit by receiving
That's
some
different.
cash. Now, that's totally different. So I just want to make sure we didn't miss that point, is that he's trying to isolate a very specific part of what he's doing in that book. That's not necessarily how you would run this day-to-day ops. So
yeah,
I
Jared,
guess
if you're gonna,
we can't go without mentioning that, though, right?
well, okay, yeah, but that's those are two different scenarios. If you're going to take a given policy, a given
Yep.
contract, a loan out against it, person dies, it's resolved internally, and then what's the remainder of the death benefit is paid out. In the case that you're
Correct.
talking about, that Nelson referred to in the book, that's two parts. So say you got to
Two
have,
different things, but they could
you
get conflated, I think, is why I brought that up.
okay. So let me just finish the thought. So you got $500,000. I'm going to surrender $200,000 of it. So now I got three. So now the taxability could impact the surrendered portion. That is true,
Yes.
but
Yes.
not the existing structure is not
That's
changed.
correct.
So
Correct.
don't surrender
Agreed.
nothing, and you won't have to worry about the taxes. Just
Love
saying.
that. Nope, I completely agree. I'm envisioning the counter argument that pops up already, or
No,
that shows up, and I just wanted to make sure that was mentioned.
That's why we're trying to tell people why infinite banking is such a bad idea.
It's horrible.
Because
idea. Don't do it.
all of these concepts that are out there need to be addressed. Opportunity costs. Do you have any opportunity costs with the money that you put into a term contract? Oh, no, it's gone. How about an IUL in a couple of bad down years? All that cash value shrinks to nothing.
Sure.
Does that happen on a permanent dividend-paying whole life insurance contract?
I mean, if we want to talk opportunity cost, let's not miss the fact of the folks who pay cash for everything. What did you lose that you could have
Yeah.
bought or
Yeah.
purchased
Yeah.
with the interest that you didn't gain on that money that's now out of your environment, that's out of your system?
100%.
If we're going to mention opportunity costs on one side, let's make sure what's good for one's good for the other as well, right? There's always an opportunity cost. Every time you pay for something, the what you could have purchased is the opportunity cost. No question. That's a simple economic description of that, correct? Yet, if we're talking the opportunity costs of someone that would be a dissenter to whole life, they would say, well, I could have spent all those funds elsewhere. I would argue if you sequence your funds properly and you sequence it through a properly structured dividend paying whole life product, you still purchase the same exact thing that you were going to purchase anyways, but you sequenced it through an infinite banking concepts policy that will be gaining internally while you made the same exact purchase you would have purchased already. So if you're going to really examine that opportunity cost, we got to be able to look at the whole thing.
let me share this one thought. I'm going to have a big tax bill this year from 2025. And I choose to take the monies that I would otherwise give the IRS and put them inside my contract. And then later on, I rotate that money out and I pay the IRS off. All is good. That time horizon on the dividend that I'm getting on these contracts, my own contracts,
Yep.
irrespective of my clients' contracts, which are some of them are even better,
Yep.
it's about $3,000. So there's your opportunity cost. I just saved myself $3,000 by keeping the money in my account and then paying it later rather than just, oh gosh, give it to the IRS so they can use it for other things. Um, no, no,
Just
it's a
just
huge
sequencing the funds, correct? Just make sure
ex-
you've got the proper
100
sequencing of the order.
100%,
Yep.
100%.
Yep.
Um,
So I guess
so
on the opportunity cost as well, we've hit kind of the other side of that on if you're a if I'm a pay cash only type of a guy, or
yeah.
any money that might be tied up in this whole life product could be earning higher returns in some, you know, investment, stock
Hmm.
market, property, fill in the blank, any investment elsewhere that you could be making more money on.
Right.
I think we've just said that if you properly structure this through or properly sequence it through your policy first, you're still able to access all of those investment opportunities, but you're gaining an internal or a guaranteed return within your whole life policy already, and you're sending it out. So I guess I don't understand why someone would say that there's an opportunity cost to that, because it's not a cost. You're gaining within a whole life policy, and you're able to deploy those funds elsewhere.
I
That
think
seems
some
like a no
people,
brainer.
yeah, yeah, for sure. I think what too many people view this as an investment, and that's where they get wound up around the
Well
axle. It
said.
is not an investment.
Well
It
said.
gives you he who has the gold makes the rules. Nelson used to always talk about that, right? So
Yep.
who's got the gold? We got the gold. If it's sitting in our contract in cash value, when an opportunity arises, or we have a deferred payment that we don't have to pay today, put the money there. Let it
That's
because
right.
it's got to reside somewhere. Why
That's
not
right.
in our bank?
Well, I
Let us
mean, you could
capture
let it
that interest.
reside. You could let it reside in your 401k and not touch it for 30 or 40 years. That sounds like a good idea.
And what interest rate
Obviously,
are you
I
going to
hope you sense
pay?
my sarcasm.
And what interest rate's going to be paid on the back end of that? Who knows?
Who
Who
knows?
knows?
Yep.
All right. How about another one? Dependence on life insurance agents. Many individuals rely on agents for policy selection. Well, okay. I'll let you answer that one. But look, do you want somebody making giving you advice that has scrubbed everything that's out there, or do you want somebody who says, "Oh, let's throw a dart at a dartboard"? The reason Jared and I are doing this is because we've done the hard work of looking at all these different life insurance companies. We know what's available out there, and believe us, if there was a better opportunity out there for our clients, we'd be on it. But we
Yep.
look, and we're constantly looking, and these companies are constantly changing their product mix.
Yep.
But I don't know about you, Jared, but I'm pretty darn happy with the contracts that I've written on myself and my clients. I have no complaints with their production, the performance of these companies.
Yeah, this could get down a pretty slippery slope if I start throwing darts at a variety of insurance agents out there, right? Like that's not my goal. These guys are
No,
working
I'm
hard,
not.
to do what they can to provide a product. I guess,
I'm saying
my
something like Select Quote. You're going to go out there and you're going to just be online and you're going to get the cheapest price, so you've got the best thing, right?
that's
There's
fair.
so much more to this stuff. You want somebody who's actively engaged in the industry and is looking at the trends and knows the history behind these companies
Yep,
and the history behind the dividends. It's very
that's right.
important to have a handle on that. That's what
That
I'm
is
getting at.
important.
I'm not
Yeah, no, I
talking about other
completely.
agents.
No, no, no. I completely agree with that. But part of the dependence on an agent is the downside, right? That's what they're viewing as a downside. So I guess one of the things that you can combat that with is, if you're considering a whole life product, remember you're engaging in a whole life relationship with that agent. Will the person who provided that policy for you be there 6 months, 6 years, 20 years down the road? Are they going to be there to answer the questions and help out when needed?
Well said. I couldn't agree with that statement. Nothing to add to that. That's perfect. Last one I'm seeing on the list, Jared, is market perception. Infinite banking is often viewed skeptically, with some financial experts labeling it as a marketing scheme. What do you say to that one?
Yeah, I guess if we're talking about a marketing scheme, you get a lot of folks out there that talk about how you're paying yourself back or how you're paid to purchase a vehicle. All of those are pretty silly, and I think that those might go a little too far in terms of how that's set up. But the root of where they're coming from comes from a good place, I think. Yet those marketing tactics might be a little thick. A lot of folks would say that you get the vibe of this is a get rich quick product. And if anything, this is a get rich slow product. Like, this is a very slow and steady, uninterrupted compound growth over years and years. Anybody that gets the get rich quick vibe, I don't think they're paying attention to what's being said.
Well, I like to stay in my lane on this stuff. I don't sell myself as all these risk asset categories. I'm very familiar with them. I worked in that world. I was a Series 763 guy. I'm very familiar with the currencies market, the options market. I don't do that. I don't talk about that stuff as an expert. I leave that to the guys that are doing that day in and day out. What you and I are doing day in and day out is infinite banking. We know life insurance as it applies and how it's applied to creating our own bank. It is a very core foundational piece of a well-built financial plan. We're not financial planners across the gamut. We don't represent ourselves as that, but we can sure show you how to set up a dynamite cash flow system so you can go in any direction you want. I would encourage people to have a good financial planner, to have somebody that they can talk to about their 401k and their other investments and their real estate. That's not what Jared and I are doing. We have our own circle of friends for our own personal stuff, for sure. But as it pertains to infinite banking and why it's such a bad idea, we've arrived at the conclusion that it is one of the most powerful foundational cash flow programs you could ever build. And I'll stand by that. Well, that's all I know. I think, have you got anything else you wanted to add, Jared?
Yeah, I guess I would just add one, closing thought, that if someone is stuck around this far and they've made it through our, the conclusion of our podcast, they'd realize that we don't think it's a bad idea. This is something we both do in our own personal lives, and that we love helping people learn about it and see what that looks like for their own personal financial landscape. And we're open to the discussion. It doesn't work for everybody, but we would recommend that you read the book Becoming Your Own Banker by R. Nelson Nash, and maybe looking outside the box a second to see what it looks like for your own personal landscape. What happens if you control the banking function for your household?
Well, look, go enjoy that beautiful scenery out your door and for the phenomenal meals, and enjoy your time out there. And we'll look forward to seeing you back in the 42-degree sunny skies of Georgia in a couple of days.
Much appreciate that, John. Thank you. Have a great day.
Thank you. Bye-bye. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.